Michael Burry thinks that inflation's now peaked, but expects a secondary surge in inflation this year. And this will happen after a US recession and then the US government spending huge amounts on stimulus and the Federal Reserve cutting interest rates. Now, is this a likely path to a secondary spike in inflation? And if not, how could we get there? This video is sponsored by Trading 212, which is a UK commission-free investment platform. So let's look at Michael Burry's inflation warning in a bit more detail. So here's Michael Burry's prediction about inflation. He thinks that it's peaked for now, but it's not the last peak of this cycle. We're likely to see CPI lower, that's consumer price inflation, possibly even negative. In other words, we'll have a period of deflation in the second half of 2023. Then the US is going to enter recession, and he says that'll be a recession by any definition, whether it's 2 successive negative quarters of growth or an NBER-defined recession. Then the Fed will cut interest rates as a result of the recession, and the government will stimulate, in other words, spend more. So we'll have a double response, monetary policy and fiscal policy, pushing in the same direction to increase US growth. But he thinks that's going to overstimulate the US economy, and then we'll have a secondary inflation spike. And he concludes, rather arrogantly I think, by saying that it's not hard to predict this stuff. There certainly have been precedents of multiple inflation spikes. So for example, if we go back to the 1970s and 80s, you can see that there was this triple spike, one in 1970, one in 1974, and one in 1980. There was another episode with a double spike, and that was in the Second World War. One peaked in 1948, and then the next one peaked 3 years later in 1951. But really since then, we've had the Great Moderation when there haven't been big inflation spikes. Only the most recent one, which seems to have peaked in June of last year. Now, if we zoom in on inflation since 2000, and also overlay what the Federal Reserve thinks, so these were the published summary of economic projections as of the December 2022 meeting. Those are the red dots which you can see here. So inflation ended last year at 5.5%, and this is the inflation measure which the Fed looks at, which is personal consumption expenditures inflation. What the Fed expects is that over the course of this year, 2023, we'll see inflation fall to 3.1%. Then in 2024 down to 2.5%, and then finally by 2025 it'll fall close to their target, which is 2%. So clearly what Burry is saying is very much at odds with what the Federal Reserve thinks. So what we'll do now is to go through the other parts of his argument. Now, the least controversial part of Burry's argument is that the US is going to enter recession over the course of 2023. And if we look at the US summary of economic projections from the Federal Reserve, they kind of agree. This is GDP growth in the US going back to 2000, and the forecast from the Fed is shown in red here. Now in 2023, they expect just a whisker above contraction, a tiny growth rate of 0.4%. And notice how it takes a very long time for growth to pick up to what would be considered a normal rate of around 2%. Even by 2025, they don't think they're going to quite be there. So are we going to get a deep and prolonged recession in the United States? I think that's fairly unlikely, but many people agree that we are going to get some kind of recession over the course of this year. Now, probably the best indicator of US recession is to look at the unemployment rate. That's defined as the number of unemployed people as a proportion of the labour force. And whenever it surges upwards, it's a very good indicator of US recession. So recessions are marked here as the blue bars. And notice that this indicator never fails. When there's an upward surge, you can see the US enters recession. And this is the basis of Claudius Salm's SALM rule. However, if we look at the data right now, notice that the unemployment rate is at a multi-decade low, only 3.7%. To find a comparable rate, we'd have to go back 50 years to the 1970s. So certainly when we look at the hard data, it's very difficult to see a recession right now at the beginning of 2023. However, there was recently a really interesting paper published by some of the Federal Reserve banks. This is by Cleason and Marks. And the paper was called "Are State Economic Conditions a Harbinger of National Recession?" So what they've done is to come up with a model which looks at whether single states in the United States are entering a recession of their own. And then if a critical number of those states is in recession, and the threshold is 26 or 29, depending on whether you include 2008, But once you cross that threshold, it's very likely that the US itself as a whole is in recession. And you can see that currently we've just tipped over that threshold. And if we look at another model from the Federal Reserve, this one is based on 4 factors: CPI inflation, the unemployment rate, credit spreads, and also whether the US yield curve is inverted. That's currently forecasting an 85% probability that the US will enter recession over the next 12 months. So I think here Michael Burry's right. We are going to see a recession in the US. It's simply a question of how deep it'll be and how long it'll be. My expectation would be that it would be fairly shallow and fairly short-lived. But where Michael Burry gets really controversial is in the response to that recession. Before we go on with Michael Burry's arguments about a spike in inflation, let me quickly mention Trading 212, which I use for my ISA, and that's for my fund portfolio. And that's because it gives me access to the exchange-traded funds, which I'd like to buy. It also gives you access to single stocks, but I use it primarily for the ETFs, and they have equity ETFs and commodity ETFs, but also bond ETFs. They also have a feature called fractional shares, where if a share is very expensive, you don't need to buy all of it. You can just buy a fraction of a share. They also have something called pies. They're very easy to create. You could just click on this button, you add instruments to it. So let's add an equity fund, and we'll add a gold fund, and we'll add a bond fund. So you can see it's roughly 1/3 in each of those assets. You can change the ratios very easily and then make sure it adds up to 100. You then choose how you want to fund it. You can either auto-invest regularly or put in manual amounts. And it's really that easy. Then in future, if you want to rebalance the portfolio, it's literally one click. Now, viewers of PensionCraft get a special offer from Trading 212 where you can get a free stock worth up to £100. To access that, just create and verify your Trading 212 account, make a minimum deposit, which is just £1, and then enter a promo code, which is my first name, Ramin. And in order to do it on your mobile device, simply click on this menu item in the bottom right, select Use Promo Code, and then just enter my name, Ramin. Now let's move on to the more controversial parts of Burry's argument, and we can start with the Fed rate cut. Now, markets have repeatedly expected the Fed is going to pivot, in other words, cut interest rates rather than hiking them aggressively. However, the Fed has been very clear in its messaging, which is that it's not going to cut interest rates until it sees convincing evidence that inflation's beaten. So if we look at the FOMC policy rate forecast, you can see that for the end of this year, the Fed expects that rates will end up above 5%. Only once it thinks inflation's coming down, which it thinks will happen the following year, will it start to cut interest rates down to 4.1%, and then in 2025 down to 3.1%. Now, of course, the Fed would cut interest rates aggressively if there was a systemic problem for the US economy, or maybe the Treasury market froze up again. But its central case is that that's not going to happen. And if we look at the Fed messaging, for example, the December 2022 meeting, it's very clear. Powell is stressing here that the Federal Reserve has learnt its lesson from those multiple inflation spikes of the past. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. So I think it would take a real disaster in order to make the Fed turn around from that statement. They think it's a necessary condition for the US economy to suffer pain, and that means higher unemployment, weaker growth, and then consequently they think that demand and supply will be brought back into balance in the US labour market and inflation will subside. And personally, I think that what they probably do is not cut interest rates back to zero. They probably just cut back to some intermediate level. The second part of Burry's expected response to the US recession is government stimulus. However, I think he's got it wrong here, and that's because of US debt dynamics. Entering the pandemic, the US debt to GDP ratio was quite low. It was around 80%. But because of all the stimulus spending, that's now surged to over 100%. And if you look at the forecast from the CBO, which is a non-partisan organization that looks at debt sustainability, you can see that now it expects the US debt is on a non-sustainable footing. So by 2032, the CBO expects debt to GDP will reach 110%, and it'll reach 185%, not far off where Japan is now, by 2052. So there's just a lot less fiscal wiggle room left for the US government. And there are other problems which are long-term. So here beside me, you can see the size of the gap between the government's income and its expenditure. It's negative because it's spending more than it earns in taxes. And that fiscal deficit is expected to get bigger in future. And the reasons for that would be aging of the population, because older people are not productive, and there are costs because of healthcare, and also net interest outlays. The government has a huge stock of debt, and the payments it has to make on that debt are now much larger because risk-free rates are much higher. So that in turn has made the US debt load potentially unsustainable. And another reason I don't think the US government is going to be keen on more stimulus is that it's already created a lot of stimulus. For example, the reshoring initiative. So the US is trying to get more manufacturing done on US soil. One example of that would be TSMC, the chip manufacturer from Taiwan, which has now invested $40 billion building factories in Arizona. And there are now several of these stimulus programs. For example, the Bipartisan Infrastructure Law that was passed in 2021. Then there was the Chips and Science Act of 2022 and the Inflation Reduction Act also in 2022. So I don't think the US government is going to be falling over itself to do even more stimulus spending when its debt to GDP ratio is already huge and growing. It would take a catastrophic failure of the US economy to make it do so. What I think is a more likely path to higher inflation will be something to do with energy. Because remember what created the spike in inflation in the first place. The starting gun for that spike was largely energy prices. So here we can see two components of US inflation, gasoline prices in blue and used cars and trucks in red. And gasoline surged hugely. This went to inflation rates of almost 60%, and that was for an extended period of time. Partly that's because energy prices fell dramatically during the pandemic as people simply went out less due to lockdowns, and then they got back into their cars and started driving around again afterwards. But then there were also supply bottlenecks for things like computer chips, which created a shortage of new cars and made used cars and trucks surge upwards in price. And there you see inflation rates of over 40%. And it's no accident that both of these are now abating, and we've also seen inflation start to turn south. What could make energy prices spike again? Well, if we look historically, and here you can see the real price of oil, and this goes back to 1960, typically it's wars in oil-producing countries, usually the Middle East, which trigger these energy spikes. We saw it in 1979 with the secondary spike in inflation, and that was triggered by the US oil embargo. We can see another spike during the Gulf War, the Iraq Civil War in 2006 to 2008, and most recently, when Russia invaded Ukraine, the sanctions and the supply disruptions that followed created another spike. So I think another Middle East war or escalation of the Russia-Ukraine war could trigger another spike in energy prices. Now, the US created the Strategic Petroleum Reserve, and that was in response to that 80s energy crisis. So you can see the size of that reserve is just over 700 million barrels, and it's been hugely depleted over the course of the last year. Now, some people think that the US gasoline prices and energy prices started to turn around just as these reserves were released. But notice that now those reserves are very depleted, and it's going to take a long time to build them up again. So if there is an energy crisis, there's a lot less buffer in order to stabilize US supply. So both on the supply front, but also the monetary policy front, because remember, the Federal Reserve cutting interest rates can't restore energy supply, I think this is a much more likely path to a secondary spike in inflation. So given the nature of the US recession, which is probably going to be fairly short-lived, but also quite shallow, I think this double stimulus, monetary and fiscal, is unlikely. A more likely outcome that would lead to the double spike would be something like military conflict, which causes some kind of supply issue with energy, because the Fed can't control that, and the petroleum reserve is now also depleted. Now, don't forget our offer from Trading 212. You get access to a free share worth up to £100 if you use the promo code, which is my name, R-A-M-I-N, Ramin. And there'll be more details about that in the description beneath me. And, as always, thank you for listening.